You know, the rental market in Canada is starting to get pretty silly when a landlord puts up their property for nearly double the market average, and they might have gotten it as well. Hey everyone, welcome back. My name's Matthew. That's my assistant Matilda. This is your weekly news recap here. It's another Friday. We're also going to be talking about CMHC and Royal LePage's forecast for the Canadian real estate market. Not surprisingly, they don't agree. Surprisingly, which one is more pessimistic is probably going to be an interesting thing to look at, and we'll finish things off talking about the condo market in Canada and inflation. But before we get started, let's get you another terrible joke. This one is from a viewer on last week's news recap. What is a mathematician's favorite food? Pie. If you have a terrible joke that I can use in a future episode, put it in the comments below. And remember, the cool kids, they leave comments, they like these videos, and they hit subscribe if they haven't already. Starting things off here, Royal LePage has updated their forecast for the Canadian real estate market, and I believe they are the first major company to predict year-over-year declines. So far, we've seen a lot of companies predicting month-over-month declines or peak to trough price ranges, but so far, I don't think anybody said year-over-year prices are going to decline, and that's what Royal LePage is now saying. They're expecting that by the end of this year, prices will be about 0.5% lower than what they were at the same time the previous year. This, of course, is a downgrade from their July forecast, where they were saying that they expected at the end of the year prices to be up year over year about 5%, and an even further decline from their early predictions earlier this year, where they expected prices to be up 10.5% by the end of this year. Of course, it's easy to say, well, boy, Royal LePage sure got that one wrong. Yeah, basically everybody at the beginning of the year got their predictions wrong. When I do my year recap or my 2023 predictions video, whichever I put this in, I'm going to be looking back at the forecasts, and trust me, absolutely nobody, myself included, got their predictions right. It is good to see, though, as data and information changes, Royal LePage is going out and updating their forecasts. Next up here, CMHC also has their forecast out for the Canadian real estate market, and they're expecting declines as well. They talked about this, they kind of telegraphed it a couple of weeks ago that they were going to announce that they're expecting prices to decline, and they're saying that potentially we could see prices decline 15% from peak to trough, and expect that bottoming out to happen in early to mid 2023. But year over year at the end of 2022, they are expecting prices to be up about 6%. So Royal LePage has prices down about 0.5% and CMHC has them up about 6%. That's probably not what most people expect. I bet most people would say that Royal LePage would have the more optimistic forecast, but it's CMHC that has the more optimistic one right now. Next topic here, I talked about it in the intro, and that is, you gotta see this listing. I'm gonna put a link to the article. The listing has now been taken down, so you won't be able to see the photos, but the landlord here has got about a 750 square foot bachelor condo, and they are advertising it for rent, or were, for $3,500 a month. Now, it does come fully furnished. I guess that's great, but let's talk about the things it doesn't have. Well, first of all, it's 750 square feet. No parking comes with it. It's got a shared entrance, shared laundry, and no pets are allowed, with a strict 24-hour quiet policy. And the market average for this neighborhood is about $1,700 a month. Now, like I said, this ad has been taken down, so I'm not sure if they actually got this price or not. With how crazy hot the rental market is, especially in Toronto, where this one is from, it wouldn't surprise me if they did. RE/MAX just released its national condo report, and they talked about a couple of centers here. So Vancouver, Toronto, Ottawa, Calgary, Edmonton, amongst a few others, that they're continuing to see price increases in condos. Now, when they say Vancouver and Toronto, they're specifically or mainly talking about those core central areas, not the periphery, where they're seeing those price increases. But across the board, we are seeing much more strength in the condo market in Canada than we are in the single family home market. And I think there's two factors that play into that. This past 2 years, we've seen the price of single family homes skyrocket really, really aggressively, whereas the condo market, they've increased, but it hasn't been as much. So we've kind of seen this split of prices going like this. I hope I did that the right way. And that has meant the gap between single family homes and condos has increased quite a bit. Then you've got buyers looking, going, well, why would I buy a single family home that is so much more expensive than a condo when I can get a pretty good condo for this price? And of course, condos are often the starter product for a lot of first-time home buyers. And of course, with higher interest rates, that means that buyers are qualified to spend less. So they might have to look at a condo because they can't afford a single family home. And RE/MAX is expecting this demand for condos to continue for the next couple of years, predominantly driven by those two factors. This next news article out of the Financial Post talking about pre-construction flippers is sure to get people fired up in the comments. I can already see you starting to go down there and typing in the comments. Now, what they're seeing is that with the softening in buyer demand, some of these flippers aren't able to flip these condos out. Quick little background, a little bit of information here though. When a new construction project is proposed, generally, the developer is going to have to get a set number of pre-sales before the bank is going to fund their construction loan. So they get those pre-sales from investors who really have no intention of ever occupying these units, but it allows that developer to get those pre-sales. As construction progresses, those investors will often flip these out to end user buyers. Any profit that that investor sees from what the purchase price they agreed on to what they can sell that to a end user buyer is theirs to keep. And this is a little bit of a win-win for everybody. The developer has those pre-sales so they can get their construction financing, while the end user, somebody wants to buy this to live in, can sit back and wait until this is closer to completion before they put their deposit money down, which potentially could sit for 2, 3, 4 years until this project is completed. And if it does get completed, well, that buyer might not get that deposit back. So a little bit of win-win for everybody involved. But now with the overall slowdown in the Canadian real estate market, there's fewer buyers, so these investors are potentially not seeing any profit at all from their investments, or even worse, not able to sell them at all. And I can see already you guys in the comment section saying, who cares? Let the investors burn. Take a step back for a second. If these investors don't buy these properties, then potentially they don't get built to begin with because that developer simply doesn't secure enough pre-sales to start construction. And then you have fewer properties available for people to end up buying at the end. And we're in a country that already has a shortage of homes, seeing an even greater shortage because projects can't get off the ground. That's not really a recipe for success and more affordable house prices in Canada. Now, some good news from CMHC. They're tracking new construction starts and seeing an uptick in starts. This is awesome. Good news. More houses being built is always good in Canada. But again, these are starts, not completions, meaning houses are ready for people to move into. If we see a slide in the economy, a recession, potentially these starts don't turn into completions. So while starts are good, completions are the more important metric to watch. But as always, I want to see more homes being started, more homes being completed in Canada. That will continue to make more housing more affordable if we have more selection for buyers to choose from. Last topic here, this is hot off the press. In fact, this just came out this morning as the time of recording. So working math backwards, you guys can figure out when I shot this video. Now, they were expecting inflation in Canada to be 6.7%, and it came in at 6.9% in the month of September, primarily driven by the cost of food, which is up nearly 12%. I think it was like 11.4%. Everybody's feeling the pinch when you go to the grocery store and see how expensive everything is, or you go out to eat and how expensive it is to eat out now. It's crazy. And then we have gas prices starting to tick back up. So don't be surprised if the October numbers aren't very good either. And the market has pretty much reacted instantaneously to this. Already seeing the betting odds on what the Bank of Canada is going to do with interest rates here next week go from kind of a 50-50 shot of 50 basis point increase to now a 60-40 guess on increases being 75 basis points. So we're going to see here in a week what the Bank of Canada is going to do. The Fed obviously raised rates 0.75% just about a week and a half, 2 weeks ago, whatever it was. So don't be surprised if we're talking next week in the news recap that the Bank of Canada's increased rates 75 basis points. Okay, you made it to the end. So if you haven't already, hit that subscribe and that like button for me. Leave a comment. That helps the YouTube algorithm out as well. If you haven't watched it already, here's my October Canadian real estate market update. Check that one out. Lots of information there. As always, guys, thanks very much for watching.